This presentation introduces Harmony Gold as a company moving beyond its traditional identity as a South African gold miner. The new investment case is built around three pillars: high cash flow, a clearer dividend story, and a meaningful copper growth pathway. Gold remains the core business, but management is increasingly positioning Harmony as a gold and copper producer. That shift matters because it can widen margins, diversify cash flow, and support a higher quality valuation over time. The key question for investors is whether Harmony can convert today's strong gold price-driven cash generation into a more durable, diversified long-term value story. This slide summarizes Harmony's current profile. The company's core offerings are large-scale gold production, rising dividend capacity, and a visible copper growth path through CSA and EVA Copper. The key risks are also clear: heavy South Africa exposure, rising operating costs, operational variability, and execution risk on copper integration and future development. In other words, Harmony offers both strong upside and meaningful complexity. Investors are attracted to the cash generation and growing shareholder returns, but they also need to price in geopolitical, labor, power, and project execution risks. That balance between cash strength and jurisdiction risk is central to the story. This slide shows Harmony's strategic transformation. Management is clearly framing the company as an integrated gold and copper producer rather than a pure gold miner. Gold remains the core earnings engine, but copper is becoming the medium-term diversification lever. On the operating side, Harmony still depends on its broad South African underground and surface gold base, plus Hidden Valley in Papua New Guinea. On the growth side, the copper pipeline includes CSA in Australia for immediate production, EVA Copper as the next major growth project, and Wafi-Golpu as a longer-term copper-gold option. This is a material shift in strategic identity and could eventually change how the market values the company. FY 2025 was a very strong cash year for Harmony. Gold production was about 1.48 million ounces, down 5%, but underground recovered grade improved to 6.27 grams/T, up 3%. The average gold price received rose sharply to $2,620 per ounce, up 31%. That helped drive total revenue to $4.07 billion, adjusted free cash flow to $614 million, and EPS to 127 US cents, up 72%. The key point is that shareholder value was driven more by margin quality than by production growth. In a strong gold price environment, Harmony converted modestly lower production into much stronger cash generation and earnings. This slide breaks down Harmony's cost structure and margin dynamics. FY 2025 cash operating costs were $1,499 per ounce, AISC was $1,806 per ounce, and AIC was $1,991 per ounce. Those are not low-cost metrics relative to some global peers, which is why cost control remains essential for Harmony. The company benefited from strong gold price leverage, with the realized average gold price at $2,620 per ounce. That still allowed very strong cash margins despite higher per ounce costs. The strategic lesson is simple. Harmony can generate exceptional cash flow when gold is strong, but in a weaker market it needs much tighter cost control than lower-cost producers. H1 FY 2026 showed another example of lower production but stronger financial outcomes. Gold production was 724,000 ounces, down 9%, and underground recovered grade fell to 5.72 grams/T, down 11%. But revenue rose to $2.56 billion, up 23%. Operating profit rose to $930 million, up 66%. And adjusted free cash flow increased to $344 million, up 8%. The average gold price received jumped to $3,421 per ounce, up 40%. This slide highlights Harmony's core leverage. When gold is strong, the company can offset weaker production metrics with much stronger realized pricing. That is a strength, but also a reminder that Harmony's earnings remain highly sensitive to the gold market. This slide covers FY 2026 guidance. Harmony's gold guidance remains stable at 1.4 to 1.5 million ounces, with underground grade expected above 5.80 grams/T. Guided AISC is R1.15 million to R1.22 million per kilogram. More importantly, the copper narrative is becoming more visible. CSA production guidance is 17,500 to 18,500 tons, with C1 cash costs of $2.65 to $2.80 per pound. The message here is that gold remains the stable core, while copper begins to matter more as a second growth driver. Strategically, management is trying to preserve gold output while using copper to widen margins and diversify future cash flow. This slide explains why copper is considered the next leg of the story. Harmony acquired MAC Copper in October 2025, which gave it the operating CSA copper mine and immediate copper production. That matters because it adds non-gold earnings and reduces the company's pure gold price dependency. The next major step is EVA Copper, where the final investment decision was approved in November 2025. Management has indicated potential production of around 100,000 tons per year of copper within a 3 to 5 year period. If that is delivered successfully, Harmony becomes much more than a gold miner with optional copper exposure. It becomes a more diversified precious and base metals producer. This slide highlights one of Harmony's hidden strengths: reserve depth. The company reports 135.5 million ounces of mineral resources and 36.8 million ounces of mineral reserves. Management says that reserve base can underpin stable gold production of 1.4 to 1.5 million ounces annually for more than 20 years. That is very important because it gives Harmony long-duration operating flexibility, not just short-term gold price leverage. It also provides a large resource pool that can potentially be converted into mineable inventory over time. For investors, this means Harmony is not just a short-cycle cash flow trade. It also has long reserve life and substantial embedded optionality. This slide focuses on shareholder returns. Harmony's FY 2025 final dividend was 155 South African cents per share, totaling 133 million United States dollars. The H1 FY 2026 interim dividend rose sharply to 530 South African cents per share, totaling 204 million United States dollars. Just as important, management introduced a new dividend framework that allows up to 50% of net free cash flow to be returned to shareholders. That is a meaningful shift. It tells the market that Harmony wants to be seen as a cash-returning value creator, not just a cyclical gold producer. If cash flow remains strong, this dividend policy could become a major part of the equity story. This slide shows that Harmony's market re-rating has already started. By mid-March 2026, the share price was around 16 United States dollars and 87 cents. Market capitalization around 10.55 billion United States dollars. Enterprise value around 10.93 billion United States dollars, and forward PE roughly 4.78. Those are still not obviously expensive metrics if the company can keep generating strong cash flow and deliver on copper execution. The market is clearly recognizing Harmony as a larger, more relevant producer than before, but the valuation still depends heavily on high gold prices and continued operational delivery. Copper execution is also important, because that is one of the main ways the company could earn a broader re-rating over time. This slide lays out the future outlook. For 2026, the company's priorities are clear. Maintain stable gold production in the 1.4 to 1.5 million ounce range, manage cost inflation, integrate CSA smoothly, and keep generating strong cash flow for dividends. For 2027 to 2028, the bigger goal is rising copper contribution and broader diversification. Management sees CSA and EVA Copper as tools to help reduce long-term or gap risk and reposition the portfolio as a gold plus copper platform. The importance of this slide is that it connects near-term execution with long-term transformation. Harmony is trying to use today's gold cash flow to finance tomorrow's diversification. This slide summarizes what investors are likely expecting and where the biggest risks sit. On the expectation side, the market wants gold guidance to hold, strong cash flow momentum to continue, CSA integration to remain smooth, and EVA to be executed without major cost overruns or delays. On the risk side, South African operational concentration remains a major issue. AISC could become a bigger problem if gold weakens, copper execution risk is real, and earnings remain highly sensitive to gold prices. This is essentially the market's checklist: stable gold, disciplined copper execution, and no major surprises in South Africa. The bull versus bear framework is straightforward. In the bull case, gold stays elevated. FY 2026 production guidance is met, CSA contributes well, EVA progresses on time and on budget, dividend growth continues, and the company re-rates as a high cash flow gold plus copper producer. In the bear case, gold weakens materially, AISC stays high or rises, South African operations face new disruptions, CSA integration underwhelms, or EVA encounters delays and cost overruns. This slide is important because it shows that Harmony's upside is real, but so is its dependence on both metal prices and clean execution. The conclusion is that Harmony is a stronger company than many investors still assume. It is no longer just a gold price trade. It now combines strong cash flow, meaningful dividends, a solid balance sheet, and a visible copper growth path. The next phase of value creation depends on three things: continued gold price strength, successful execution in copper, and effective cost control. If those come together, Harmony can continue evolving into a more diversified and higher quality miner. If not, the stock may remain viewed as a high beta, higher risk producer. That is why the outlook is attractive, but still very execution dependent.